Welcome to the Directed IRA podcast.
Oh my gosh, that was dorky. Now, some of you may be wondering why we would ever do that in unison. It's because we're here together.
Yeah, Mark is in Phoenix.
We are live in Phoenix, and I really feel uncomfortable about the social distancing. So I'm going to put on a mask.
Oh, thank you.
No, I'm just joking.
Thank you. I have the vaccine, so you're okay. I volunteered, got the vaccine.
Yeah.
Such a good citizen.
I'm going to get my vaccine and be sterile. So,
okay.
Yeah.
All right. I thought you already were.
Well, we're going to make sure. Okay. Yeah. Several people have said, make sure that you nail the coffin in that one. We don't need any mini marks out there anymore.
Yeah.
No, but I'm here. I'm here in Phoenix with the amazing co-host, Matt Sorensen. My name is Mark Kohler. Welcome. If you haven't been to the podcast before, it's also on YouTube, Spotify, iTunes, Stitcher.
Yeah. Wherever you consume podcasts, we are. And on YouTube, you can see us in person together. This is rare.
Yeah.
So it's good to be here. So it might be a little more jovial than you're used to.
Yeah.
Just because of
a little more awkward.
Yeah.
I'm now touching Matt in a very inappropriate way.
Yeah. We are business partners.
Only.
Yeah. But just, we are tax lawyers. Mark's also got the extra nerdy distinction of being a CPA as well. So, but we love the topic of self-directed IRAs, how they can be invested into real estate, crypto, private companies, any of the cool things you want to do, which is what our clients do here at Directed IRA. And Mark's wearing his swag.
Yeah, I'm representing today. If those on YouTube, I've got the logoed shirt of Directed IRA. I'm representing. I'm excited to be here. I left this cold Idaho tundra to get on a flight to Phoenix this morning at 4:30 a.m. And I had a sweatshirt, a beanie, and I got on the plane and there's guys in, flip-flops and shorts. I'm like, this is a whole other world. It's weird.
This is the sweet time in Phoenix, of course. Okay, well, today we're going to talk about how your IRA can partner with other people or other accounts. Sometimes you got money in an IRA and you want to make an investment, but you don't have enough to pull off the investment. How can I bring in other resources to do it? A partner, another retirement account of maybe mine or a family member. So we're going to walk through the ways you do that, some of the landmines. There's some landmines.
Yeah, there's a few. But a lot of people are shocked that there's a lot. If there's an area that is open for creativity without a lot of problems, this is really it. There's a lot of great ways to partner in an LLC with IRAs. And I'll give one quick example. I've been really harping. Some of you are going to get sick of it. Matt's told me to back off a little bit. I'm a big fan of the Coverdell, which is the education savings account. Now, on the first blush, everybody's like, you can only put in $2,000, and what can I do for college for a kid with $2,000? Well, I'm like, hey, if you start when they're underage 5, 6, 7, 8 years old, and you partner that Coverdell and other projects with your other IRAs, your exponential rate of return could really turn that into something special. And people are like, oh, I can partner my Coverdell with my other IRA? Yes. See, so now the Coverdell looks a little more sexy.
Yeah.
A fair statement?
It does. It can come along for the ride now. Because otherwise, what are you going to do with $2,000? Maybe buy a little Bitcoin with it, but I don't know.
The Coverdell's in the back seat. Are we there yet?
Yeah.
Really let it, do its job.
Yeah. Someone's got to be in the front seat driving it with all the money. And that's maybe your traditional IRA or Roth IRA. All right. Well, I think it'd be helpful to go over some examples just to illustrate it, maybe at first. And then before we get into rules and things like that.
Well, let me say this, though. I think the first rule, as we go through these examples, can your IRA partner with individuals? Yes. Can it partner with you? Yes. Can it partner with other IRAs or retirement accounts in your family or your own? Yes. So, and then the examples start. It could be pretty cool, really.
So I guess this is the first principle off of that point. Your IRA cannot transact with you, right? I can't have my IRA and go buy a piece of real estate from my IRA, or I can't have my IRA own real estate and lease it to me personally, right? That's my IRA transacting with me, and I'm a disqualified person, which is prohibited. If you're not familiar with that, go back to the earlier episodes where we go over IRA rules. But when I'm partnering in an investment with my IRA, we're not investing between each other. We're co-investing into the same thing. So we're not transacting. Remember, it's the prohibited transaction rules. The IRS is concerned with your IRA buying something from you, or your IRA transacting with your spouse's IRA and doing something unfair for tax purposes. But you can co-invest into something.
I like it. Another way to say it is there's prohibited transaction rules, but there's not prohibited partnering rules.
Oh, see what you did
Can I have
there.
a drink to your Diet Coke?
Yeah,
Too?
this is
Can you
okay.
share?
Yeah.
Now that we're here together, I'm just going to drink Matt's drink too.
Okay, yeah, I'm such a bad host.
Well, no, it's okay. And
There are some in the fridge. You know.
Yeah, back in the studio in Idaho, I can have the producer like make me look more tan than Matt. Now it's like really,
Yeah.
the real color test comes out. I might still have you.
What's hilarious actually is I just did this like a day ago. I got this little like Island of the Sun self tanning drops.
Oh, yeah.
And you put it in a moisturizer,
Okay.
and then I put it on my face. So I think that's helping too.
Yeah, you look good.
That's helping
You
too.
look like a Oompa Loompa.
It's not that bad.
No, you're not orange. You look good.
All right.
Okay, so you give the first example. Let's
Okay.
do our favorite examples. Because really,
Okay.
people, I think this really does, like you said,
Yeah.
exemplify what's possible.
Yeah.
Is just examples.
Okay, here's the first one, and I love this one because it's the most common that I've helped clients with over the years. Let's say your IRA's got 100 grand in it, and you're looking at a piece of real estate that's worth 150. You're like, I could get it. Maybe I get a non-recourse loan and I buy it, which you can do. Go back to the real estate episode if you're not familiar with that. Sometimes people are like, you know what? I just want to buy the thing outright. My spouse has 75 grand over in an old employer 401k. Can we put those two accounts together and go buy the real estate? Yes. So we would take the spouse's old employer 401k, roll it to a self-directed IRA for him or her, take your own account, and now those two IRAs partner into a new LLC. That LLC is going to go out and buy the property. So now I'm able, and real estate's the most common one because it's one of those things where it's like let's say you want to buy Amazon stock. You're like, well, I only have enough to buy 10 shares. Well, then just buy 10 shares. Well, I want to buy more shares. Okay, have your spouse's account go buy 10 shares with their account. Okay. Well, real estate's not like that, right? You got to buy the whole thing. Right?
Yeah. We need a bank account.
Yeah. So how do we accomplish that? And the LLC is perfect because it solves a number of issues. First, of course, like any LLC in real estate, you're getting asset protection. Something happens on the property, they have to sue the LLC. They can't come after you or the IRAs. But more importantly, for the IRA rules, we're going to break up the ownership in that LLC. So let's say your account put in 100 grand, your spouse's account put in 50 grand. Your account's going to own 66, one third. Your account's going to own 66, one third. Spouse's account, 2/3. Oh my gosh,
That's
dang
okay.
it.
You're doing great. This is a lot of pressure.
I mean, I'm
No.
not a CPA, guys. I never wanted to be. Okay. You know what I'm saying here? Your
Yeah.
account's got put in 100,000 of 150, so you got 2/3 ownership. Your spouse's account puts in 50. Spouse has 1/3 ownership.
Yep.
Now you've got 150 in the LLC. You go buy the property. Okay, rental income comes in. What do you do with that? The LLC is going to pay expenses. The cash flow is going to come down 2/3 to your account, 1/3 to your spouse's. So we're always breaking up the ownership, the cash flow, the income based on the dollars invested.
Okay. Now I'm going to add a couple distinctions or some additions to
Okay.
Matt's example. When Matt said we're going to do it together, or we're going to remember, you still have two separate IRAs.
Yeah.
Everybody, a lot of people think, oh, I can bring my spouse's IRA and combine it with my IRA. Not at the IRA level. You're going to combine it at the LLC level. So keep that in mind, everybody. You still have two separate IRAs.
Yeah. And these LLCs, we call them multi-member IRA LLCs. We do them at the law firm, KQS Lawyers, and there's a whole chapter in my book on the multi-member IRA LLC.
Yeah. And we've been doing them for 15 plus years. We really feel like we've been the thought leader on the LLC in the country. And some other attorneys may take issue with that, but they're not here to defend themselves. So
Right, yeah.
it is what it is.
Start their own podcast.
Yeah. The second thing I would say that I would clarify that Matt said at the very end of his example is when that rental income is received, it goes to the LLC bank account, and it stays there. Heck, You might just pool it there for years and years and go buy other rental property with that same LLC. You may say, hey, we got 10 grand sitting there. Let's go buy some stock out of that LLC, or let's go do some crypto, or go buy some cows, or buy another smaller project. So, or loan it to someone. So that LLC can keep doing business. In the end, when it's dissolved or you're ready to spit out some profit, then it'll go 2/3, 1/3 to the IRA, not to the individual. It's got to make a pit stop at the IRA.
Yeah. Okay. Yeah. That's called the multi-member IRA LLC, which is probably the #1 tool to use when partnering with other people or with other IRA accounts as we go through this. So just that's a one to know, multi-member IRA LLC.
And see, I want to move to another cool example, but I think we need to stay with this one example and build on it.
Okay.
So let's say the rental property is 200 grand.
Okay.
You had 100 in your IRA, your spouse or business partner, friend, brother, sister, kid. Or remember that we probably could add that variable.
Yeah.
It could be anybody.
Yeah.
Anybody, family or not, has 50 grand. Let's say it's mom. Mom has 50 grand sitting around in an old IRA, but you're short 50. So you got the 100, you got the 50, but the rental property is 200 in this example. Can you put in 50 grand of your own money? Yes. So now you still have a multi-member LLC, but now there's 3 partners. And that has to be pro rata, which means ownership is reflective of how much money each person put in. So you put in your IRA put in 100 grand, 50%. Your mom's Roth or IRA put in 25 grand, 50 grand. So she's 25%.
It's kind of hard.
It's hard, man. Jeez, I'm smart as a 5th grader, damn it. Okay.
So much better.
Yeah, you're vindicated. And then you put in your own money of 50 grand, you personally get 25%. Now, is that prohibited? No, because you didn't buy anything from your IRA. You didn't sell your IRA property. You're not going to go do the work. You're going to have a third-party property manager. So you want to go back and listen to the podcast of ours of what's prohibited once the property is purchased. But you have an LLC and you've got 3 partners now, and you get to be a partner too.
Yep. Yeah. Now this LLC is a partnership for tax purposes, as was the first example, because there's multiple owners. So a lot of times in a single member LLC, or sometimes called a checkbook IRA LLC, where just one IRA owns the LLC 100%, no tax return required to the IRS. Yeah. But here we've got multiple partners, even if it's 2 IRAs that don't pay tax, the IRS still wants a partnership tax return. That's a Form 1065 to say, here's the income, here's the expenses, here's a K1 that says how much profit this IRA gets, how much loss this one gets. Now in Mark's example, where we've got your IRA, mom's IRA, and you personally, let's say you had 10,000 of profit after all the expenses in this LLC. Well, your IRA is going to get a K1 for $5,000 of income, does nothing with it because it doesn't pay tax on rental income or capital gain, whatever your income you had from the rental. Mom's IRA gets a K1 for $2,500 for the 25%.
We're in a rhythm now. We're in a rhythm.
Nothing with it. Yeah. Took a while. And then you got a K1 for $2,500 for your 25% stake. Now that's going on your 1040 because that was not retirement plan money. So that'll go on your taxes, of course. So,
and it's your money.
Yeah. And you can spend it right now.
Yep. Yeah. Now, if you do a distribution, now see, that's the K1. This is called phantom income. The K1 is going to tell the IRS how much profit there was, but that you may have left the 10,000 in the bank account, which you can do, but you get a K1 for $2,500 and you're like, what the hell? I got to pay taxes on $2,500, but no one gave me $2,500. It's stuck in that LLC over there.
Yeah.
That's okay. It's called phantom income. Pay the tax. Don't cry about it. You've got profit now that's been taxed sitting in this LLC someday. You won't have to pay tax on it again. Now, if you do a distribution, that also has to be pro rata. So if you distributed now let's say you leave 9,000 in the account and you distribute $1,000. Okay. Then you'd send $500 to your IRA account at directed IRA, $250 to mom's Roth IRA at directed IRA, and you would get a check in the mail for $250. So distributions are separate from K1 net loss or net income and have to follow the same percentages.
Yeah.
Ooh.
Yeah.
No.
Now remember, you can be manager of this LLC. So you can be manager of the LLC. You don't get to take a salary or take any compensation, but you're the one actually cutting the checks. You know, you're sending the check to the IRA if you're distributing money out. Now, as Mark said earlier, you don't have to. Let it just all build up in the LLC. Just grow this as an investment account, reinvest it into whatever next investment you want to do.
Mm-hmm.
Okay.
Now, please be careful if you see out on the web, oh, I don't have to do a tax return because my IRA doesn't owe taxes. Now, on the face of it, you're right. The IRA doesn't owe taxes, but the IRS doesn't know that your IRA is an owner. The IRS is in the dark, and they're going to get pissed because they see that there's a tax ID number. There might be 1099s being issued to that tax ID number. There could be a HUD statement, an escrow state. So there's going to be business going on, and you're thinking, well, I don't owe taxes anyway, so why do I have to do a tax return? Well, the IRS has to be kept in the loop. And when you don't do a tax return, the penalty for a 1065 is $295 per partner per month, up to 6 months, I think. So in a situation like you and your wife's or you and your husband's IRAs doing the $150,000 deal, there's no person in it. So you're saying there's no taxes, but the 1065 is still required.
Mm-hmm.
And the penalty sucks. So do it. We
Yeah.
can help you here. We got the accounting firm that can do that. But do your extension, which is a good note that the extension for those LLCs is due back on March 15th. The little May 17th extension some of you are thinking about was for your 1040, not for 1065s. So your penalty might already be ratcheting it up. So if you're sitting driving down the road or on a treadmill and your heart's just skipped, get that 1065 done.
Yeah. And this is for any LLC.
Yeah.
You know, that's a partnership. So,
okay. Another fun example.
okay.
What do you think?
Did you want to build on this one or you want to change lanes?
Do you have one to build on it?
Yeah.
Okay, go ahead.
Let's throw another variable in there. Let's say that, let's take this same $200,000 piece of real estate. Let's say that you still got $100,000 in your IRA. Mom's got $50,000 in her IRA. You're going to throw in 50 grand personally.
Okay.
But this needs a rehab.
Ooh.
Okay.
Good variable.
And
I was wondering where you were going.
Okay. All right.
Okay. Now
this property needs rehab. And you've got a friend that happens to be a contractor, not a disqualified person that says, you know what? I'll do the rehab, but I want a percent of the profits in the deal. In fact, I want half the profits.
Oh my gosh.
All right.
Now this guy's a Yahoo.
I picked half because I can do the math on this easier. It doesn't, you know, whatever.
You'd probably kick him out, but you'd punch him in the face.
Hell no.
Okay.
But for example purposes, I like him claiming half because I can run the math easier.
All right.
Okay. So we got 200 grand of cash coming in. I got someone putting in 50% ownership. That's going to be worth the same as that 200,000 of cash. So I really got value here of 400 grand if you think about it.
Yeah.
Okay. Now, if you have a work partner coming in, I'm going to break down the things here, but when you have a work partner coming in, that can't be you. Okay.
That's
it
right.
can't be anyone disqualified to your IRA or your mom's IRA. The work partner has to be a non-disqualified person. So this is just a friend that's a contractor or just some professional contractor.
Rule number one.
Okay.
Love it.
Rule number one. Okay. Now let's break down the ownership. The property's 200. The total value is 400 because 50% of this ownership is getting allocated to the contractor for services. So if I'm putting in 100, I'm going to get 25% ownership for my IRA. My mom's IRA is putting in 50. Her IRA is going to get 12.5% ownership.
Yes.
Okay. I'm personally putting in the other 50. I'm going to get 12.5% ownership. So now between my IRA, mom's IRA, and me personally, I've got 50% ownership. The other 50% is getting allocated to the work partner.
Yeah. And there's two ways to go at that and skin the apple. That's why I didn't jump into your rescue there for a minute, because I was like, okay, how I usually go at it is I take that. What Matt did is the capitalization ratio. He said, okay, if this guy's at 50% and they put in 200, then we have a 400 total cap value. That's a way finance people would look at it. Another way to look at it, kind of down and dirty, is you work backwards. You say, well, how much does the work partner want? They want 50%, and let's do another example. They want 10%. And a lot of times if the contractor's not putting money in, they're just going to oversee it. we've got,
Don't give them 50.
yeah, you're going to give them, let's say 10%, which is going to bring me to the variable I wanted to come to in a moment. But let's say we give them 10%. Then you take the remaining 90 and divide that up pro rata, 50% to your IRA, 25% of 90%. So you take 0.5 times 90, 0.25 times 90, 0.25, and that gets you your 90%. So you kind of carve out the work partner first and then divide up the rest pro rata. You end up in the same spot.
Yeah.
But again, whatever makes sense to you, tomato, tomato.
Yeah.
Okay, now here's my variable.
Okay.
The contractor, let's stay with the 10%. Contractor says, I want 10% to supervise it. You're like, that's cool. But what's the rehab going to cost? Oh, it's going to cost 50 grand. Another round number there, like that. Well, we don't want to go put $50,000 more into the LLC. Can the LLC go get a loan? Yes. Now, this is very common where you hear the term, some of you in real estate, is hard money. See, the property is paid for. You already bought the property. It's free and clear. Oh, hard money lenders, they're like salivating over that because they're like, well, I'll give you 50 grand and you probably pay 2 points and 10% per annum at least. Sometimes they can be highway robbery. Sometimes you can get a better deal.
It's a little more competitive now. You might get 7 or 8%.
Ooh,
yeah,
okay.
Rates are pretty good. The hard money lenders even got to compete.
Yeah. Now, when we say hard money, what it means is they're not looking for a personal guarantee from anyone, and they're taking a lien. Sometimes they want one.
They won't.
Okay. But they can't get it from you, the
Yeah.
IRA people. They've got to get it from the contractor.
Yes.
But let's say you get there's no personal guarantee. They're going to take plain 10 they're going to take a 50 grand, give it to the LLC. They're going to take a lien against the property. Now, when there's that much equity involved, I think you have a better argument of not getting personal equity, personal.
And if you've had a track record of doing these before, even personally, you have more negotiating power.
Yeah.
If this is your first deal and there's hardly any equity in it, they're going to be like, I need a personal guarantee, bro.
Now, does the hard money lender get ownership? No. Is the hard money lender loaning you, your IRA, or the contractor money? No. It's loaning the LLC. They're going to take a first trustee lien against the LLC and the property owned by the LLC. And frankly, what they're wishing is you default. I mean, they just want to come in and take that property. So you're highly motivated to move quickly. You want to pay the least amount of interest, borrow from the hard money lender, do your rehab, the contractor oversees it, and then you go to sell the property for maybe $300. And then at that point, you pay off the loan, you split the profit, pro rata, blah, blah, blah. So, but the point I'm just trying to get at is you could have a loan involved.
Yeah. Let me go through the example I gave of the work partner getting 50% ownership. Okay. Let's say you bought the property for 200. That, the work partner maybe put in their supplies and materials and they did all the work and just fixed it up so you didn't have any cost. Let's just keep it simple. Let's say you sold the property then for 300. Okay. Let's walk through how that money goes back. And this is typically how you want to structure this in a partnership deal like this. First, the cash partner should get paid back their money. So if there was the $300,000 sell, that 200,000 is going to get paid back first. So your IRA that put in 100 grand is going to get the 100 grand back. Your mom's IRA that put in 50 gets her IRA gets the 50 grand back. The 50 you put in personally, you're going to get that 50 grand back personally. Now we've got 100,000 in profit. This is where the contractor is going to get half the ownership, half the profit here, 50,000, and then your IRA is going to get it's 25,000, 25%, 25,000. Your mom's going to get 12.5 and then you'd get 12.5. So just keep in mind, generally when you're partnering and you bring in a work partner, you want the operating agreement to say the people who put in the cash get their cash back. Then we split the profits based on the percentages.
Yeah. And this can be really tricky. We could spend the rest of the hour going through what's the basis, how much improvements were completed, was there a loan, is there interest, how much profit would be split up. But that's not the purpose here. The purpose of this show is to say, you can have debt, you can have a service partner. So let me add another let's add a whole new idea. Idea. Okay. So this was our text earlier today. We had one of our attorneys say he's got 2 clients with IRAs, and we kind of threw this around. We have a kind of a collaborative text group amongst all of us tax attorneys trying to make sure you get the best result whenever you come here. And so whenever we're kind of like in a new, like, oh, this is an interesting one, we'll throw it around because we want all of our tax attorneys to learn from it. So this guy, our attorney in the office had 2 clients with IRAs, and they wanted to do crypto mining. And some IT guy said, well, I can do all that IT work and get you a sweet rig, set it up, monitor it, and get us a kick butt return, but I want 50%. And the 2 IRAs are going to buy the rig. So it's not real estate, but it's still the same concept.
Yeah.
Just like Matt's example, you have a contractor. In this situation, it's an IT guy. So you can plug and play whatever the project. It could be import export. It could be a restaurant.
He's an importer exporter.
Yeah, it could be Vandalay Industries for all you go.
Does he do? What business is he? He's in the imports. Just imports, or does he do exports? He's an importer exporter.
Yeah, it could be an architectural firm too. Yeah. So,
well, I had a good one even this morning. One I looked at was LLC of multiple people investing their IRAs into one LLC. It's a group of around 5 to 10. And the reason they were pooling into an LLC is that LLC was investing in a venture capital deal. This was a startup pre-IPO deal, and they wouldn't let just one person in at a time at $50,000. They're like, the minimum investment was about $500,000. And so for them to get to that minimum, this group of people, which composes some IRAs, some individuals, threw into a multi-member LLC. That LLC then went in and made this investment that had a minimum set on it. So that's another reason to do the multi-member IRA LLC.
Yep. And what's funny is right here, if you're watching on YouTube, I've had to multitask. I'm moving around money in kind of some family matters, but that's my next example. I think a lot of people, again, feel like self-directing is not for them because they don't have enough capital, just like this hedge fund type deal where they needed a certain amount to pay to play. Well, I think what's fun, and this has been my biggest kind of hobby horse or whatever you call it, I'm kind of riding this off into the sunset lately, is I want families investing together more. I think it's a great opportunity to teach family about money, teach financial literacy, and get some great tax write-offs in the mix. So if you're paying your family members, your kids, your spouse, parents, I've done all those over the years in different scenarios. Why not let them create a retirement account and invest with you? They're in a lower tax bracket, so paying them to invest with you could save you taxes. And then you're also passing on a legacy. There gets to be a point where you're like, I've made enough money. Now I need to teach my family how to do it. So I've created in our family a little LLC that has 8 partners, 8 different Roth IRAs. Cool. We have a little board meeting. Well, what are we going to do? Are we going to invest in stocks? Are we going to invest in real estate? Are we going to give a loan? Are we going to buy into a little hair salon or a little restaurant? And that can be a fun experience where you have this family LLC where you're not doing sweat equity, but you can certainly make decisions together and meet together. Can't pay for a trip to Cabo, but
Yeah.
you can make the decision in Cabo, just not let the LLC pay for the trip. So, but I think that's fun too.
Yeah, that's a good one. And I've always loved the clients over the years that I've seen that are doing this cool deal, and like the kid's Roth IRAs in there. The kid doesn't even know that he or she has it, and owns 1% of this LLC that owns a rental or an apartment building or something like that. I've always been like, man, that's cool. So, all right, now I want to we talked about, pros. Let's hit the pros. I can partner multiple accounts and people into one investment, generally using a multi-member IRA LLC. That's the common way to do it. The con to that is I've got a partnership tax return. Okay. I've got multiple people in there, but I got to do that anyways. If Mark and I just partnered in something personally in an LLC, we're going to have a partnership tax return. Okay. It's just how it is when partnering in general. Okay. The second con, though, is a little unique for retirement accounts. And that is, let's go back to that example of your IRA, your mom's IRA, and you personal. Let's just keep it simple at that one.
Okay.
And your IRA's got 50%. Your mom's IRA's got 25. You personally got 25. Now, let's say you put in the total at $200,000 to do that deal. You need $10,000.
I knew you were going here.
You need more money.
Uh-oh. But that never happens in business.
Yeah.
You never need more money.
This is a rental.
We're going to make profit.
The AC unit, you're kaput. You bought the property 1 month later, AC unit kaput, and it's not even leased. The tenant left.
I don't want to partner with partners that think this negatively.
Yeah. I mean, you're paid prepare,
Yeah.
be prepared.
Yeah.
So how do I need more money in. How do I get the 10,000 in?
Well, mom's IRA can do the whole thing.
Mm,
Oh,
that's
no.
where we screw it up. Okay.
Okay.
This is where it can be a little clunky. And this is one of the things you need to know when you're doing this multi-member partnership IRA LLC. If you have these disqualified people in this LLC, you personally, your IRA, your mom's IRA, these are all disqualified. So if I need 10 grand, I've got to follow the same ownership percentages I had when I set the thing up. So I'm going to put in 5,000 personally because I own 50%.
No. IRA was
IRA.
50. Yep.
IRA is going to put in 5,000 because it owns 50%. I'm personally going to put in 2,500 because I own the other 25%. And my mom's IRA is going to put in the remaining 2,500 because her IRA owns 25%. You have to follow those ownership percentages. One, money going into the LLC, more money later, and as it's coming out and you're taking money out at the end.
Now, some of you may go, well, this sucks. I can't do it. Because what happens if we need more money than the annual contribution allows? So let's say you need 50 grand and mom's got to put in 25%, which is 12.5, and she can only put in 7 grand, assuming she's over age 50. So you're like, well, I'm setting myself up for failure. No. Can mom roll in other IRA money from another location into the same IRA account and then contribute?
Mm-hmm.
Yes. So if you have other IRA accounts, you could move money around at the IRA level to get where you need to be.
Yep.
Also, go ahead.
I say, on that point too, I have some clients that do kind of like, they do wholesaling, and some options on real estate. And they've got husband, wife account and kids Roth IRA, and they each own 1/3. Okay. And they're like, hey, every year we're just going to throw in the $6,000 a year. Everyone's account's going to get $6,000 contribution. We're equal 1/3. We're going to just throw in $6,000 a year. It works.
Yeah,
we're going to make money and grow it off of the investments that we're making as we go. Plus we get a pop in 18 grand every year from 6 from each of us. And they're kind of like off to the races on that. So sometimes if you think it through and you're planning to put more money in every year, think through how much can you contribute. You can kind of lay out a good structure and plan.
Yeah. Now, some of you may be thinking, what happens if I have an LLC and we don't have enough IRA money? That's another podcast. Mm-hmm. We'd like to do in the next 2 to 3 podcasts a show about what happens when my multi-member LLC or my single member IRA LLC is cash strapped. And Matt has researched this to the nth degree. There are some Department of Labor rulings that do allow for some unique solutions, but that's a podcast for another day. So don't worry about that. Just say we can make contributions. Now, another one that I kind of like, that's kind of a backdoor strategy. Let's say your IRAs in this LLC need more than 6,000 or 7,000. Mm-hmm. You don't have other IRA money to throw in from another different IRA. Could I create a solo 401k, make a contribution there, and then roll that out to an IRA? Ooh, that'd be tricky.
Probably not unless you're retirement age, because you can't throw it into a 401k and it can't get rolled out to an IRA.
Now, and the reason why I bring this up is I want people thinking through this. Where could I find the money? Well, let's say you have an old 401k. You may say, well, that's not an IRA. Oh, if you're not working there currently and it's an old 401k, you could roll out a portion of that to an IRA to help make an additional contribution.
Yeah. The other thing to consider is, and I've had clients do this, is just get a third-party loan.
Yeah.
Just have a third party. If it's a temporary expense you need, a brother or sister or someone else loan the LLC money, they'll get interest on it. And then, once the LLC recovers, whatever the issue was, they would just pay the loan off. So you just get an unsecured, or they could even secure it, bring in some debt to cover an unexpected expense. What I like to tell clients, particularly on real estate, because this is common on real estate, when they're buying an asset, is like, if we're buying the $200,000 property, don't actually fund it with $200,000. I know that was the example I just gave, but if it really is 200 total, like you should be funding it with 220. Like have a 10% cushion there, so that if something happens, tenants are out, an unexpected repair comes, you're not having to scramble to get more money in it. Now, if the LLC starts doing well and you're like, I've got plenty of cash flow, I just got money sitting there, remember, that's good for your next deal. Or once it's stabilized and you feel safe, just distribute it out.
Yeah.
just send it back then to the IRAs and to you personally.
Or pay a
Easy.
big legal bill. You could pay a big legal bill with it.
Just send us a big retainer.
Yeah, I'm not opposed to that. I'm trying to think of other cons, and right now, none come to mind. But let's talk procedure. Now, in these multi-member LLC ideas, this ain't happening on LegalZoom. And a lot of times the parties involved have a lot of questions, and you don't want to play lawyer on TV, and you don't want to be accused of screwing over someone's IRA, mom, dads, brothers, sisters, or friends, whatever it is. And this is where directed IRA and KQS lawyers have really worked in concert over the years. So plan on probably a two-step process. I'm going to say this simultaneously. One option is have everybody start moving their IRA accounts or the IRA money they want to use for the project, start opening accounts at directed IRA, getting the money there. Sometimes that could take a couple weeks or more, depending on who the broker or dealer is that the money's coming from. Meanwhile, you're making an appointment with one of the attorneys. Our attorneys are going to be out 1 to 2 weeks. We always try to expedite that when there's a transaction pending or a group. So don't stress. If you call us up and you guys are out 2 weeks, that's because we're good. That's not a bad thing. You want to be like, hey, these guys know what they're doing. They're that busy. But if you have a transaction,
it's like walking into the restaurant and there's no one in it, and you can get served immediately. You're like, do you think the food there is any good? No, nope. It's not.
Yeah, you've all had that experience. Oh, all the tables are open. Let's leave. So, but be patient. We've had some clients lately. They're like, you can't get me in for 2 weeks. I'm out of here. And we're like, well, is there a transaction pending? No. Well, then what's the hurry? Get it done right rather than fast sometimes. Now, we know when there's an urgent matter, let us know. But set up the consult with the attorney as you start the process of moving money. And then, all comes together.
Yeah, you can get the IRA accounts going, get the transfers going. At the same time, you're getting your appointment, and we get the LLC docs going. And we can get clients in usually within a few days at the law firm. We do have a little special calendar for directed IRA clients. For
That's true. That's true.
So,
but some clients don't call up and say that. And
right.
we don't want you to so if you are a directed IRA client, make sure you throw that down on the phone, because the team members, male and female, that make appointments are like, ooh, they're directed IRA clients. They get a little red carpet. Yeah,
you get a special treatment. So, and we do have a intake sheet also at directedira.com that gets the accounts going, and it gets the info for the LLC. So if you go to directedira.com and the IRA LLC page, you'll be able to find that info. Also got a video on the multi-member IRA LLC. So that's the.
Oh, now a couple of thoughts. You can pay for the legal work out with your own money. See, some clients are like, I don't want to deplete my retirement account to pay the legal bill to set up the LLC. And you might be out a couple grand, by the time you do legal fees and all that. But to really pool together a project of money, that's okay. It could be a little less than that if it's a single member LLC. It could be more, because we're going to ask you, do you have your family trust completed? Let's get all this done at once. I don't know what the fees are exactly going to be, but you can pay for those individually and let your IRA money be exclusively used on the project. So you get a better end result. So don't feel like you've got to deplete IRA funds.
Yeah. And we charge just for an IRA LLC where the IRA owns 100%, $800 plus the state filing fee. Multi-member is $1,500 plus the state filing fee. So it can be affordable, and there is a privilege transaction exemption, like Mark said. It's 4975 D10. For the geeks out there, for the legal fees, are exempt from the privilege transactional. So it works in this instance.
And we've seen clients pay twice that, or more, 3 times that. So, if you're here gathering data, please know this isn't an infomercial, but it's to let you know what's out there.
Yeah.
It can be a jungle.
Yeah.
Gosh, I had something else. What do you have?
I had one last comment here, and we got to wrap up, is there are ways some people can partner in deals without an LLC. The only one that I've seen that works is a tenant in common on deed to property. Where let's say Mark's IRA puts in half the money and it owns 50% tenant in common interest on the deed. My IRA puts in 50% of the money. It owns a 50% tenant in common interest on the deed. That's fine. Here's the problems though that I see with that. Let's say it's a rental property. How's the rental check going to get cut? Is the tenant going to send half to Mark and half to me? What happens when there's a bill paid? Am I going to send half the money and Mark's IRA is going to send half the money? So it can get a little clunky sometimes. Like if it was raw land, you got to cut a property tax bill once a year, maybe. But I think for rentals and stuff like that, it can be dicey. Maybe you get a property manager in the mix that can help solve that issue. The other thing that doesn't work, though, is joint venture agreements.
Ugh,
joint venture agreements do not work with the IRAs. There's a few sophisticated ones. If you've had a lawyer prepare it and spent thousands of dollars, that's more complicated than just doing a multi-member IRA LLC.
Yeah, it's like just freaking do the LLC.
Yeah, so the multi-member IRA LLC is built. It works for this. If you want to do a joint venture, it's going to be way more complicated and expensive, and it may not get funded. There's not many IRA custodians I know that done them. I think I've maybe allowed 5 here, and these are super sophisticated structures with lawyers that signed off on them. Not our firm, other outside lawyers. So.
I remember what I was going to say.
Okay.
So let's talk about bringing these partnerships together from a practical standpoint. I alluded to this a little bit about timing, but it's more than that. Let's say that you're talking to your mom or your spouse or partner or family and saying, let's do this. Maybe everybody's not bought in at first and they're not ready to open accounts yet. You can always start with that You can always start with the consultation, which we apply towards the LLC if it comes together within a few week period, where the consultation can knock out the same process on the front end rather than everybody being on board on the back end. So what I'm saying is
consult at KQS lawyers.
Yeah. That's the consult with the lawyer. So we're not going to charge $1,500 for the first appointment. If you just say, I just want to have a partnership call, everybody on Zoom, whatever, and have the attorney explain how this is going to work. Answer everybody's questions. And then if everybody's like, oh yeah, I'm on board, team go, go team, then that's when the attorney can then start gathering data for the LLC, and everybody can go be working on their directed IRA accounts. And I would add, in this concert of parts coming together, if you're doing cryptocurrency, be thinking about, where am I going to have the wallet? With these LLCs, you got to apply for a wallet sometimes 3 to 4 weeks out. It's not as fast as getting a personal wallet at Coinbase or somewhere. Also, if you've got a real estate transaction going on, make sure you communicate with the realtor, the broker, the seller, the buyer. Get an extension or get a contingency that we've got to bring this LLC together. And so the more you can help communicate with everybody, it's okay. Mm-hmm. It doesn't have to happen overnight. A lot of people call up stressed out that they've got to do it tomorrow, and we get it. Sometimes you do, but also know there's a lot of moving parts that you can start going, so they're simultaneously coming together at one point, rather than doing A, B, C, D. That could take you 2 months. But if you start A, B, C, and D all at once, it might take you 2 weeks.
Yeah. Good call. Love it. And this is, I got chapter 14. This is my own copy. I have to read my own.
That's do you want me to sign it for you?
No, let's not ruin it.
Oh my word! Oh, that hurt.
Hey, you're in there. I referenced.
That's true.
That's true.
I'm in the cover.
I gave a good plug in the acknowledgement section.
Yeah, it's true.
Yeah, right before you even get into the book,
Yeah, read the acknowledgement section. It's it's really nice, really well stated. It's a Pulitzer Prize level.
Yeah. Okay. Well, do you have anything else on this?
No. Get out and partner. We tell people buy 1 rental a year, and they think, oh, I've got to have hundreds of thousands of dollars. No. Find 2 other suckers and go do it. Find 2 other partners and go do it. You don't have to do every deal by yourself. Partner with others.
Yeah. I own real estate by myself. Mark and I own real estate together. Does that mean I'm the sucker?
No, okay. I'm just saying, that was a joke.
All right. Well, thanks everybody. I want to give one last plug here. Oh, this is nothing important.
Okay.
Sorry about that. I was going to try and
bring it into the show.
Pretend like it was, planned for.
President Biden's on the phone wanting to self-direct. Okay.
Yes. Is the Self-Directed IRA Summit.
Oh,
I was like,
oh my gosh.
Self-Directed IRA Summit, April 23rd and 24th. You go to sdirasummit.com, sdirasummit.com. You can learn more about it. It's a day and a half. We're going to be up together again in Rexburg out of the studio where Mark's at, just bringing some awesome self-directed education. We're actually going over today some of the content we're planning for. It'll be awesome.
Sounds like a Sonny and Cher, reunion. It's going to be good. So, and We're going to do breakout groups. We really want people to collaborate, network a little bit in this as well, but really just get some hardcore content, because it's hard in a podcast or a webinar in 1 hour to just vet everything. You can't do it. And so the summit is extremely affordable. Sorry you cannot attend in person. The one in the fall, tentatively is going to be here in beautiful Phoenix, a little charity golf tournament involved, lots of good Mexican food. Can we do that?
We will. Yeah.
Okay. All right. I'm putting in my hat right now for some good Mexican. I'm up in Idaho. There's not, meat and potatoes. I mean, you want a good ribeye? Come up to Idaho.
And a good baked potato.
Yeah, good baked potato.
Loaded.
Yeah, loaded baked potato. We got that down, but not the enchilada with green sauce. No, you need to come to Phoenix.
Yeah.
So
all right.
okay.
Thanks, everybody.
See you next week.